Hi, welcome back to Joe Blogs. In today's episode, I want to provide you with an update as to what's happening in the economy in the United Kingdom. If you've been following the channel, you'll know that the UK is in deep trouble at the moment as a result of a combination of factors including high inflation over the course of the last 18 months, rising interest rates, which is having a negative impact on both the property market, which is a really important part of the UK economy, and also consumer spending, and also the impact of Brexit. In 2016, the United Kingdom decided that it wanted to leave the European Union. That exit process took a number of years and was a long drawn out process and has left the UK in a much worse position because all of the goods that it's now importing from its European neighbours are taxed. So previously it was part of the free trade agreement, it's no longer in that agreement, so that's increased the price of everything in the UK. So things are currently looking bad in the UK, and it's just been announced that Birmingham City Council, which is the third largest city in the United Kingdom after London and Manchester, has effectively declared itself bankrupt. And the City Council is the local authority that has to pay for all of the public services. And this council has run out of money and basically is no longer able to pay for all of those services. So this is a major warning sign that there are now starting to be real problems manifesting themselves on the ground in the UK. And to make matters worse, the latest house price index has been released and shows that house prices are falling at their fastest rate since 2009, which was the global financial crisis. And the data from the latest Purchasing Managers Index, which tells us whether companies are growing or contracting in the UK, has also produced some really negative results for August. So in today's video, we'll have a look at exactly what's going on at Birmingham County Council. We'll talk about the latest house price data and how this impacts on the United Kingdom economy. We'll look at the Purchasing Managers Index. We'll check out what's going on with inflation, interest rates and GDP. And then finally today, I'll wrap up with my summary as to what I think is likely to happen in the United Kingdom over the course of the next 3 to 6 months. Now, you may be surprised to see me back in the Joe Blog studio, back on camera, because I'd been off camera for some time. And the reason for that was that I took a poll some time ago asking people whether or not they prefer watching me or if they'd like to see footage. And the overriding message from that vote was that everybody preferred to watch actual footage rather than me talking to screen. If you are interested in seeing me and hearing more from me and maybe finding out a bit more about me and talking about some other issues, then check out my Patreon page because I'll be posting a lot more face-to-face videos over on that channel. And if you've got some questions or anything that you'd like me to discuss or ask or chat through, then let me know, send me a message, and you'll be able to check out more videos like this on the Patreon channel. But if you don't like Patreon and you don't want to do that, you can always support the channel either by checking out my Buy Me a Coffee page or having a look below where you'll find links to YouTube super thanks and membership. Birmingham, which is the third largest city in the UK and has a population of around 2.6 million people, has declared itself effectively bankrupt. Birmingham is actually the largest local authority in Europe and has issued a Section 114 notice preventing all but essential spending to protect core services. The key problem that has triggered this cash crisis for Birmingham relates to a court ruling in 2010. The Supreme Court ruled in favour of 174 mostly female employees working in roles such as teaching assistants, cleaners and catering staff who had missed out on bonuses which were given to staff in traditionally male-dominated roles such as refuse collectors and street cleaners. And in the period between 2012 and 2023, the council has had to pay out $1.1 billion to settle equal pay claims. However, they are now facing an additional bill of £760 million, and they do not have the cash to be able to pay that. And Birmingham Local Authority has stated that the costs of the equal pay claims are increasing at a rate of between £5 million and £14 million every single month. The council's financial problems have also been made worse by the implementation of an Oracle IT system, which was intended to streamline council payments. The flagship system was expected to cost $19 million, but after 3 years of delays, it's been revealed that the total cost is now running at around $100 million. Because of its predicament, the council's interim director of finance, Fiona Greenway, has issued a Section 114 notice which confirmed that there are insufficient resources to meet the equal pay expenditure and there would be no other means of meeting the liability. Local authorities in the United Kingdom cannot be made bankrupt, but the issuing of this notice is often described as being effectively bankrupt, meaning they can no longer make new spending commitments and must meet within 21 days to discuss the next steps. Most councils in such a position pass an amended budget reducing spending on services. GMB, the biggest union among Birmingham City Council staff, said the announcement was a humiliating admission of failure on the part of the council's leadership. Not only are they responsible for creating this crisis through years of discriminating against their own staff, but even they no longer believe themselves capable of fixing it. For decades, the council has stolen wages from its low-paid women workers, running up a huge equal pay liability that has brought Birmingham to the brink. Thousands of city employees will now be worrying for their future and their jobs and the essential services that they provide to the people of Birmingham. The monthly house price report for August 2023, produced by the Nationwide, one of the biggest mortgage lenders in the UK, shows that house prices fell by 5.3% year on year, which is the biggest annual decline since July 2009, which was at the time of the global financial crisis. Prices dropped by 0.8% in the month alone, which is the largest monthly fall since March, and follows on from a 0.3% decline in July. And one of the reasons that this is incredibly important to the United Kingdom economy is the high level of home ownership. This chart shows the levels of home ownership in the UK over the course of the last 10 years. And you can see that the UK currently has home ownership levels of around 65%. So that means that around 2/3 of all of the eligible adults actually own their own home. And this is a major thing in the UK. This is something that everybody aspires towards. Everybody wants to have their own property, to buy their own apartment or house and have a mortgage and live happily ever after. And one of the reasons that everybody wants to buy property is that on average, over the course of the last 50 years, there has been a huge increase in the value of property. This chart shows the movement between 1975 and the current levels, and you can see that the average price back in the 1970s was sitting at around £100,000. However, today it's closer to £250,000. So if you'd bought a property 50 years ago, you'd be sitting on a profit of more than 2.5 times right now. And if we jump back to the home ownership chart, you can see that over the course of the last few years, there has actually been an increase in the percentage of home owners. And one of the reasons for that is that between the global financial crisis in 2009 and the end of 2021, the official rate of interest in the UK was less than 1%. And that meant that mortgages were very cheap. So people could borrow large amounts of money for very little cost. But as we talked about earlier in the video, over the course of the last 15 months or so, we have seen a rapid increase in interest rates in the UK, which has pushed up the price of mortgages. And this chart shows the movement in the average mortgage rate in the UK over the course of the last 5 years. And this shows that in 2019 and 2020, mortgage rates were very attractive, sitting at or around 4%. And in fact, a lot of deals were available in the market at less than 1%, which seems crazy. But the UK has a very different dynamic to countries such as the United States and Canada. In the UK, the most common form of mortgages are short-term fixed rates. So people lock into a rate for 1 or 2 or 5 years. And the way that the mortgage companies build those rates is that they give you a discounted rate at the front end. So you might be able to get the benefit of a 1% mortgage for 2 years, which sounds amazing. But at the end of that 2-year period, your rate will then convert to a much higher rate. And this is one of the problems that a lot of the homeowners in the UK are now facing. This chart shows the breakdown of fixed rate mortgages in the UK, dating back to the start of 2022. And this shows that in 2022 and 2023, the majority of mortgage deals that were agreed were at less than 2% interest, which indicates that these are short-term fixed deals, 1 or 2 years. And if we look at the right-hand side of this chart, you can see the number of mortgages that are coming to the end of their fixed rate over the course of the next 18 months. So a lot of these are at a rate of less than 2%, and the majority are between 2 and 2.5%. And if we now jump back and look at what the average mortgage rate in the UK is today, you can see that it's close to 8%. So people who have bought property who are currently sitting on a short-term fixed rate of around 2% are going to see an increase in their mortgage costs upon maturity of almost 4 times. And obviously, that is going to be a major problem because the majority of people who have mortgages, their mortgage payment represents the single largest outgoing every single month. And it's unlikely that the majority of mortgage holders will be able to afford an increase of 4 times in that payment. Most people simply don't have the ability to do that. This chart shows the Purchasing Managers Index for the United Kingdom over the course of the last 12 months. And if you followed the channel, you'll know that we've talked about the PMI for a variety of different countries. This is a survey that's taken amongst purchasing managers. So these are the individuals that are buying in raw materials and other goods to feed their companies in terms of whatever they're making. And the reason that this index is important is that it gives us the heads up as to whether or not companies are expanding or contracting. And the key number when we're looking at the PMI index is 50. The scale on the right-hand side of this chart goes from 48 at the bottom to 56 at the top. If the PMI index is above 50, that tells us that businesses are expanding, and that should be good news for the economy because as they grow, they will make more profit, they will pay their people more, and therefore their people will spend more in the economy, and it all leads towards a growing economy. However, when the figure comes in below 50, that tells us that companies are contracting, they're reducing the amount that they're purchasing in, and therefore that's usually bad news for an economy. And if we look at what's been happening in the UK, you can see that in February, March, April, May, June and July, the index was recorded above 50, so that indicates growth. However, as you can see, the trend in May, June, July and now August is downwards. We've got a reduction in the Purchasing Managers Index. And the official figure that's been recorded for July is 49.5, which is obviously below 50, so indicates contraction. And is actually the first time that the index has been below 50 since January 2023. So what this tells us is that over the course of the last 4 months, business confidence in the UK is falling, and it's falling at an accelerating rate. And we've now got to a situation where the companies in the UK are starting to contract. They're buying in less raw materials, and therefore this indicates that the UK is going into a further period of slowdown, which is obviously bad news for the economy. This chart shows the movement in the rate of inflation for the United Kingdom over the course of the last 5 years. And the reason that I'm showing it over this scale is that the target rate of inflation for the United Kingdom has been set at 2%. And if you follow the channel, you'll know that we've discussed this a lot. The reason that government set a target rate of around 2 or 3% is that some growth in prices is seen as being healthy, because that enables companies to be able to pass on price increases in terms of all the raw materials that they're buying in, and also to be able to pay their staff wage increases. And as you can see from this chart, in 2019 and the first part of 2020, inflation was running at or around that target rate of 2%. In 2020, inflation started to fall as a result of the impact of the COVID-19 pandemic, when we saw a lot of businesses close down and the level of activity in the United Kingdom fell. However, in 2021, as the lockdown restrictions were released, we saw a rapid rise in the rate of inflation. And this was due to a combination of factors. Firstly, there was the pent-up demand. Everybody had been sitting at home, unable to actually do anything. So once all of the restrictions were released, everybody wanted to go out and spend. So we saw a huge increase in demand. And at the same time, there was limited supply because a lot of companies had closed down their operations, and so there wasn't a lot of stock. So we had a situation where demand exceeded supply. And as I'm sure you'll be aware by now, when you have a situation like that, it causes an increase in prices. And to add further fuel to the fire, in February 2022, Russia invaded Ukraine, which threw a huge question mark over the global supply of energy and food products, because Russia was a major supplier of both to Europe and the rest of the world. And as a result of that, we saw a huge spike in a lot of commodity prices, which led to a further increase in inflation in the United Kingdom. And you can see from the chart that by the second half of 2022, inflation had risen to more than 10% in the United Kingdom. Now, if we zoom in and have a look at what's happened to inflation over the course of the last 12 months, you can see that between August 2022 and March 2023, inflation remained persistently high, above 10%. And the first time that the UK saw a marked reduction in inflation was in April, when it fell to 8.7%, remained at 8.7% in May, fell to 7.9% in June. And in July 2023, there's been a further fall to 6.8%. So obviously what we are seeing here is a downward trend. However, the problem for the United Kingdom is that the current rate of inflation of 6.8% is still around 3.5 times higher than the target rate of 2%. So this is not the end of the road for the UK. The United Kingdom authorities need that inflation to get down to 2%, and therefore the Bank of England will continue increasing interest rates until it hits that target level. Now, one of the areas that I always like to have a look at when we're talking about prices is what's happening to food prices. And this chart shows the movement in food inflation in the United Kingdom over the course of the last 5 years. And as you can see from the shape of this chart, it's very similar to what we looked at for general inflation. However, the levels are somewhat higher. Back in 2019 and 2020, food prices were moving broadly in line with the Bank of England's expectation on inflation at around 2 or 3%. Prices actually fell year on year at the end of 2020 and the start of 2021. However, since the middle of 2021, we have seen a rapid increase in food prices in the United Kingdom. And it's interesting to note that those increases in prices actually started accelerating in the second half of 2022 and hit a peak of 19% in March and April 2023. And if you look at the latest release figures for July 2023, you can see that food inflation has increased year on year by 14.8%, which is significantly higher than the overall inflation level of 6.8%. And as we've discussed many times before on the channel, this is a problem for the poorer members of society. If you're on a lower income, you will spend a proportionately higher amount of your monthly earnings on food because it's a basic requirement. It's a necessity. You have to pay for food. And unfortunately, food prices are indiscriminate. They are the same for everybody, whether you are rich or poor. And although the United Kingdom is a first world economy, so people are not starving to death on the streets, an annual increase of 14.8% is putting a lot of pressure on many families in the UK right now. And the UK authorities and the Bank of England are focused on trying to bring food inflation down, and the way that they're going to try to do that is by continuing to increase interest rates. This chart shows the movement in the official interest rate in the United Kingdom over the course of the last 5 years. And this shows that in 2019, prior to the COVID-19 pandemic, the official rate of interest was 0.75%. Interest rates were then reduced to 0.1% in March 2020, following the outbreak of the COVID-19 pandemic, and remained at those levels until December 2021, when they were increased to 0.25%. And since that time, we have seen 14 consecutive increases in interest rates to the current level of 5.25%. And you can see from the shape of this chart, which basically looks like a very steep staircase, that the Bank of England has been increasing interest rates in virtually every single month. It decided that the best form of action was to introduce small increases on a regular basis. And if you take a step back and look at the numbers, since December 2021, rates have increased from 0.1% to 5.25%, which is an increase of 52.5 times. This chart shows the UK's GDP figures, which are published on a quarterly basis for the last 3 years. And what this shows is that in the second half of 2020, the UK was officially in recession alongside the majority of the rest of the world as a result of the COVID-19 pandemic. Now, as I've talked about before on the channel, the recession that was officially recorded back in 2020 was exceptional. The reason for it was that the world stopped. Everybody closed down because we were worried about the health implications. Nobody wanted to go to work. So it wasn't really a genuine recession. This was something that was forced onto most countries around the globe. And if we then have a look at what happened in the second half of 2021 and the first part of 2022, there was a bounce back. As the restrictions were released, everybody went out and started to spend, and so we saw a boom in the economy. However, that boom was relatively short-lived, and everybody was brought back down to earth following Russia's invasion of Ukraine as a result of the huge increase in all commodity prices. And in the second half of 2022, GDP fell to 3.8% and then 2% at the end of the year. And if we look at the official figures for the last 3 quarters, you can see that the UK is currently struggling. At the end of 2022, the official GDP figure was 0.6%. In the following quarter, it was 0.2%. And in the most recent quarter, it was 0.4%. So basically, at the moment, the UK is seeing virtually no growth whatsoever. Officially, it's not in recession. It's avoided that official title. However, these figures are very poor and show that the UK is on its knees. So what's the summary and conclusion today? Well, I wanted to post this video to give you an up-to-the-minute update as to what's going on in the United Kingdom. And the data that we've seen is obviously all bad news. We've seen the Purchasing Managers Index coming in below 50 for the first time since the start of 2023. So that tells us that companies on average in the UK are contracting. We've seen the house price index falling at the fastest rate since 2009. And that was the time of the global financial crisis, the worst period in terms of the housing market over the last 30 years. So we've got an equivalent situation going on right now. And the problem with that is that the housing market underpins the economy in the UK. There is a high percentage of home ownership in the UK, and a lot of people feel wealthy because the price of their house is going up, and therefore they feel that they've got more money to spend and invest. However, when house prices start to fall, people start to get very nervous. They start worrying about the size of their mortgage and they spend less. So this can have an accelerating impact in terms of the slowdown on the economy. And what we've seen in terms of the news coming out of Birmingham, the third largest city in the UK, is that their local authority, who are in charge of all of the essential public services, has declared itself bankrupt. It's run out of cash, it's got no money. So therefore, it's going to have to cut back on its budget. There's going to be a reduction in public spending in that area. And that will have a huge knock-on impact because the domino effect in the economy works in both directions. When there's a general increase in spending, that has a positive impact. But when there's a decrease, such as there will be in Birmingham as a direct result of these cuts, then that means that local businesses will be getting paid less, people will have less money, and there will be a general sense of nervousness that spreads throughout that whole area. And I will bet that this is not the last county council that we see getting into difficulty over the course of the next 6 to 12 months. The straw that's broken the camel's back in terms of what's going on in Birmingham is the equal pay settlement that was actually given against Birmingham back in 2010. However, there have been problems in a lot of other county councils across the UK over the course of the last 4 or 5 years. We've got a lot of councils who are struggling to balance the books and make ends meet. And the problem that you've got when you've got issues in the public sector is that they employ a lot of people. So people are having to either be made redundant or not get pay rises or have their hours reduced or something that's going to impact on their income. That is going to have a direct knock-on impact for the UK economy. And as we've also seen in today's video, inflation is still running significantly higher than the target rate of 2%. It's still up above 6%. So that means that the Bank of England is extremely likely to continue increasing interest rates. They've got another meeting coming up in a couple of weeks' time, and it's very likely that they'll add another 25 basis points. And that will probably only bring inflation down by maybe 1%. So there will be a follow-on increase in interest rates. So we've still got quite a way to run in terms of where the interest rates are going to cap out in the UK. And as I've mentioned in previous videos, it takes around 3 months or so for the impact of these interest rate increases to feed through fully into the economy. So the increases we've seen over the last few months are still feeding through, and the ones that they will be increasing over the next couple of months will have a further detrimental impact. Now, GDP in the UK is just about managing to stay in positive territory. So the UK is not officially in recession right now, but there is a strong likelihood that the UK could definitely move towards recession at some point over the next 6 to 12 months, particularly when you look at the fundamentals and what's going on with mortgage rates and fixed rate mortgages. As we've discussed in today's video, the majority of mortgages in the UK are a short-term fix, and as those fixes mature, the rates that people will be moving on to will be significantly higher. They could be 2 or 3 or even 4 times higher than what people have been paying over the last couple of years, and that is going to be budget busting for most people. They won't be able to afford it, and we could potentially see a wave of property sales being forced onto people because they can't keep paying those mortgages. So the overall summary of today's video is more bad news for the United Kingdom. The Purchasing Managers Index that's just come out tells us that companies are now contracting. We've got house prices falling at the fastest rate since 2009, and we've got the council for one of the major cities in the UK now effectively bankrupt. So I'll keep you posted on any further news as and when it's released. Hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said and you'd like seeing me back in the Joe Blog studio, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.